The next organization is called the IASB, and this stands for International Accounting Standards Board. Now, the way it works right now is that in the United States, we follow the FASB that we talked about earlier, Financial Accounting Standards Board. But that's only in the United States. Every country around the world has its own rules for accounting. And as you can imagine, there's a lot of inconsistency in those rules. The way accounting is practiced in the United States is not the way it's practiced in Mexico, for example, or France, or the United Kingdom. Every country has their own rules. So what this organization wants to do is to create new accounting standards. And these new standards, these international standards, would be used by all countries around the world. And the idea is it would clear up all these inconsistencies. So this is something that is being worked on, and who knows, perhaps down the road in future accounting classes, we may not even be talking about the FASB. We might be following the international accounting standards. So that's a really good example of how the profession of accounting changes, and how we as accountants not only need to learn all this material, but we always have to keep up with the latest developments to make sure that we're following the newest rules and the newest procedures. The next organization is called the SEC, and a lot of people are very familiar with this organization. It is the Securities and Exchange Commission. Securities and Exchange Commission is another organization that is responsible for rules and regulations, but the difference here is that this is for any company that sells stock. So any company that sells stock falls under the jurisdiction of the SEC. And down the road, we will begin dealing with corporations, publicly traded corporations, companies that are selling stock. And when we get to that point, we'll be very interested in these rules of the SEC so that we can make sure that we are recording things properly. The next thing we're going to take a look at would be accounting principles. And these are some basic foundation principles that we follow in accounting. Some basic guidelines, basic rules that are always followed in the accounting profession. The first principle is called the cost principle. And it's a very simple, very straightforward principle that just simply says that accounting information is always recorded at the actual cost. Now, when you look at that statement, it seems so simple. Accounting information is always recorded at actual cost. Most people would say, well, isn't that obvious? I mean, don't we obviously use the actual cost? But if you think about it, this is a very important principle, because think about this example. Let's say that we had a business and we needed to buy a vehicle for our business. And we're going to go to a dealership and we're going to negotiate with the salesperson on the price of that vehicle. And maybe if we're lucky, we can negotiate and get a very good deal on the vehicle. Now, when I buy that vehicle, how do I record that? Do I record that at the original manufacturer's price, a suggested retail price? No. I record that at the actual cost, the actual price that I paid. So as simple as that little principle is, it's actually very important, because what it does is it removes all the judgment. It removes all the guesswork. It removes all the opinion. When I buy something, I simply use the actual price that was paid. And as long as I do that, I'm in compliance with the cost principle. The next principle is revenue recognition. Now, there's lots of different businesses out there, and different businesses make money different ways. Some businesses make money by selling products. Some businesses provide a service. But no matter what it is that the business does to make money, that money is considered to be revenue. And the question is, how do I record that? How do I recognize that revenue? Well, the principle says revenue must not be recognized until it has been earned. So in other words, until I deliver that product, or until I provide that service, or until I do what is necessary on my part to complete the job, only then can I actually recognize the revenue. So that's a very important principle in accounting. The next principle is the full disclosure principle. Now, full disclosure, if you see that word disclosure, to disclose means to reveal. So full disclosure means that as an accountant, we have to reveal everything. So even if it's something that makes the company look bad, we still have to reveal that. We can't use our opinion. We have to be objective. We have to be honest, open, objective, and we have to reveal all information if it's of a financial nature about the company. The next principle is called the matching principle. And this principle states that revenues and expenses must be matched to the proper time period. In other words, if we spend money and we also make money, that needs to be matched up in the actual time period that occurred. And there's going to be a lot of things that we're going to be recording in future examples and future problems that are going to be recorded according to that matching principle. It's going to be a big reason why we do certain things that we do in accounting. Now, in addition to the accounting principles, we also have accounting assumptions. And these are just basic assumptions that we agree with as accountants. The first assumption is called the going concern assumption. And this one simply says, we will presume that the business has an indefinite life unless information suggests otherwise. So what this is really saying is, we assume positively, optimistically, that the business will always exist. It will always be there, unless we know otherwise. So if we specifically know that we're going to go bankrupt or we're about to shut down the business, if that's the case, then clearly we wouldn't assume that. But otherwise, we just assume that the business will last indefinitely. And that just gives us the justification to record certain things that we have to record. The next assumption is very simple and straightforward. Monetary unit. All the information that we record is in monetary units. Very simple. But why is it in monetary units? Because that's a format that everybody can understand. If you record everything in dollars and cents, you can't argue with that. It's the exact value that you're recording it at. The next assumption is time period assumption. And basically what this says is that for accounting purposes, we can divide time into different time periods. And we can do that for any length of time. So for example, if I wanted to prepare a financial statement for an entire year, I could do that. I could prepare the statement and show everyone that in a year's time, this is how much we made, this is how much we spent, and so forth. But I could also do that for shorter time periods. I could prepare a monthly report, or a weekly report, or even a daily report. So I can cut time down to different time periods for reporting purposes to show people under different conditions and different circumstances exactly how the company performed during that time period. And we will do that eventually as well. The next assumption is the business entity assumption. And this says that for accounting purposes, we can divide the business into different departments or different entities. So for example, we could take a business and divide it into different segments. We could say that we have the office segment, the sales department, the warehouse, the manufacturing facility, the shipping department. We could break the business down into whatever components that we want, and then we could report on each component and show how that component performed financially. So that business entity assumption gives us the ability to do that. And again, eventually we will be doing that in some of our reports. And the next item we need to talk about would be ethics. And of course, ethics are very important in any profession, but especially important in the accounting profession. And the reason for that is we actually want people to feel confident in accounting. We want people to have faith in accounting and to have respect for that profession. And there have actually been some scandals in recent years involving different businesses that have had an effect on the impression that people have of accounting. So as a result, it's led to this new legislation. And this new legislation is called the Sarbanes-Oxley Act. And this legislation is designed to increase the rules and the regulations of accounting. And the purpose is to strengthen the profession of accounting so that we will have everything be consistent, accurate, and so that way people will have faith in the financial statements and have a certain level of confidence that an accountant is a fair and objective person who records things properly. So many times as we progress through the semester, you will see different instances where we will do things, and it will be because of this Sarbanes-Oxley Act. It'll be because of that we record things a certain way to ensure that we are being consistent. So that ends this lecture on the introduction to accounting. And like I said, the purpose of this lecture is to just give you some background information, basic principles, basic assumptions to get you started in accounting, so that way as we move forward, you'll already be familiar with some of the groups involved and some of the principles that we will be using.